Bismillahirrahmanirrahim. My name is Professor Nizamuddin. I'm a qualified chartered management accountant from England as well as from Pakistan. I'm a qualified banker also, and I've been in this teaching profession for the last 45 years. And I've been teaching not only in Pakistan but even overseas for so many years. Now, the subject which I'm going to talk today is the management accounting. Invariably, it is also known as managerial accounting, and also it is known as strategic management accounting. So do remember that we should discussing not only the short-term decision making but as well as the long-term decision making in the subject of managerial accounting. Now, in this subject, basically we have to look into for 7 C's. Those are: number 1, economy; number 2, efficiency; number 3, effectiveness; number 4, environment; number 5, equity; and the number 6 is ethics; and number 7 is efficacy. Now let me explain you all these one by one. Number 1, economy. Here economy means that we should procure and use the input resources adequately and efficiently. Now the input resources are there 5 M's basically. Number 1 is the material, number 2 is the manpower, number 3 is the machinery, number 4 is the market, and number 5 is your management. Now if you look all these 5 M's, if there is a proper coordination of these 5 M's, only then the things can work out. Now when it goes to the process, that is the efficiency, here we mean that we should be putting these resources into process in such a way that the process should avoid as much as waste of resources, because we have been currently a lot of changes in processes. In fact, a lot of efforts have been made that how the processes can be improved so that the efficiency, we should get the efficiency out of the resources. Now, third one, effectiveness. In this case, do remember that we are here to try to find out the outcome. So what is the outcome of input resources and then processing them? Here we also try to avoid as much as possible the waste. Waste is basically an activity which is not adding value to the organization. So this is very important that we should be avoiding waste at any time. Fourth one is environment. Environment, here we should look into internal and external environment as well, because the environments are also very, very important to look after, and we should see we must know what is going on around us, that is the awareness. And number 2 about environment is the anticipation, that if things are going like this, what will happen, let's say in future. And we must opt to these environments, because you can't change the environments immediately. You have to look into it. But currently many organizations are taking care that they are changing the environments around their businesses. For example, if you look the packages or miller tractors, they have created a lot of grass and these gardens and all that things, because environment add efficiency to the business. Then fifth one is equity, and equity here means that these 3 groups of people, customers, employees and suppliers, they all should be given due share in the success of the organization. For example, customers want not only the satisfaction but the delightness, plus they want to be surprised also. Now, so far employees are concerned, they should be also given equal shares, because they are contributing a lot to the organizations. Now, so far suppliers are concerned, here the suppliers does not mean only the suppliers of goods and services, but also the suppliers of finance, which include shareholders also. So if you take care of all of them, then only then the company can succeed. The 6th one is ethics. Ethics here means that we should not compromise the integrity, because divine values should be kept in view all the time if you want to succeed in any organization. Then efficacy means here that we should keep in mind all the time the results we want to achieve, because every person in the organization is trying to achieve his or her own objective, but make sure that they should keep in mind all the time that the organization objective should be achieved. You should not really undermine the corporate objective in any case. Now let's go to the definition part of the management accounting. Management accounting is basically the process of identification, measurement, examination, analysis, preparation, integration, and communication of information. Basically, here we do that we prepare the information for the decision-making purposes. Now, information is also an asset, very, very important assets, and if it is faithful information, only then it will serve the purpose. Now, if you look into these processes of management accounting, we do the planning first, then we have the controlling, and then we have the decision making. Now, in planning, we find out what we are going to do tomorrow, or maybe in a month's time, or a year's time, and even in 5 years' time, we should plan ahead. So that is the important thing. And for planning purpose, we need to assume so many things, so we must take due care of those assumptions before we plan ahead. Controlling is simply that what we planned and what we achieved, just to compare them and see whether we are going according to the planning or not. Now, in controlling purpose, do remember that we should not here just to control the cost, but we should take care that the effective measures we are talking about, they should motivate the individual as well, the employees as well, those who are involved, they should be motivated. It's not simply just to curtail cost or something, no. We should try to motivate the workers. We should try to motivate the employees in the organization. Now it comes to decision making. Basically, managerial accounting, most of the time we are taking decisions. Everybody in life taking decision every now and then. So a balanced decision, a right decision should succeed. If you have taken a wrong decision, that you may mislead, you may go wrong. So we must take care of the decision making process very firmly. Next is that when we are talking about the measuring and evaluating the performance, do remember the performance evaluation is not simply that you just see what is planned and what is achieved, but you should look into it that how we can measure the actual measurement, because sometimes it happens the plan is good, but when we are calculating the measuring the output resources, we may go wrong. And then if you compare a wrong actual figures with the planned figures, then the result will be very, very drastic. So we must be very careful that the actual performance should be calculated, or rather properly. There should not be any mistake so far actual performance is concerned. What sometimes it happens that due to some unavoidable circumstances, what you planned cannot work. So there should be some flexibility also, and we should revise our plan if the things are going out of your control due to some unavoidable factors. Then we have another one about the managerial accounting. We must keep in mind that the environment is very, very essential, and we should look into it, how the things are going around us, because you can't simply wait a good opportunity, but you have to see these, even the small opportunities can be made a success in the business. Now, if you look into the concepts of managerial accounting, the number one is the accountability. Well, accountability means simply that you have to fix responsibility on someone, because you have to give a charge of somebody for something to do. So if you can't simply assign a job and simply you can't look into that personality, so find out a right person for the right job. Next, we have the reliability, because if the information provided is not reliable, or let's say if it is wrongly presented, then it's very difficult to take proper action. You can't take the decision later on if the information is not reliable. Then similarly, you have relevancy. Relevant information should be provided to the relevant people. You should work out only the relevant information which is required for the decision-making purposes. Similarly, you have the controllability. Controllability means we must keep in mind that we need to control the resources, that we should not just keep spending whatever. No, we have to a budget, and accordingly we go by that budget. Now, details of these concepts one by one. The first one is accountability. Management accounting present information measuring the achievement of objective of an organization and appraising the conduct of its internal affairs in that process, in order that the further action necessary can be taken based on this information. It is necessary at all times to identify the responsibilities and key result areas of individual within the organization. Second one is controllability. Management accounting identifies the elements of activities which management can or cannot influence and seeks to assess the risk and sensitivity factors. This facilitates the proper monitoring, analysis, comparison, and interpretation of information which can be used constructively in the control, evaluation, and corrective functions of management. Reliability, number third. Management accounting information must be of such quality that confidence can be placed in it. Its reliability of the user is dependent on its source, integrity, and comprehensiveness. Fourth one is interdependency. Management accounting, in recognition of the increased complexity of business, must assess both external and internal information source for interactive functions such as marketing, production, personnel, procurement, finance, etc. This assists in ensuring that the information is adequately balanced. Next one is relevance. Management accounting must ensure that flexibility is maintained in assembling and interpretation of information. This facilitates the exploration and presentation in a clear, understandable, and timely manner of as many alternates as are necessary for impartial and confident decision to be taken. The process is essentially forward-looking and dynamic. Therefore, the information must satisfy the criteria of being applicable and appropriate. In simply, if I put it in one word, the information should be faithful. Now, the word faithful means that whosoever is going to use should be confident enough that the information is reliable, and if he uses that information, it will produce some good results. Now, the next is evolution. Now, I divided this evolution in 4 stages. The first one is the prior to 1950. Second one is by 1965. Then third one is 1985. And fourth one is 1995. But currently, there's a lot of improvements in the managerial accounting. And let me just say how things were in 1950. The focus was on cost determination and financial control through the use of budgets and cost accounting technologies. Stage 2, the focus has been shifted to the provision of information for management, planning, and control through the use of such technologies as decision analysis and responsibility accounting. Third stage, attention was focused on the reduction of waste in resources used in business processes through the use process analysis and cost management technologies. Fourth stage is attention has shifted to the generation or creation of values through the use of technologies which examine the drivers of customers' value, shareholders' value, and organization innovation. While these 4 stages are recognizable, the process of change from one to another has been evolutionary. Cost determination and financial control, information for management planning and control, reduction of waste of resources in business processes, creation of value through effective resource uses. So in my opinion, it's not only that from 1950 onward the management accounting has evolved, but think about these various worldwide, let's say, Egyptian pyramids, or maybe in India, these Mughals who have done so many buildings, constructed so many buildings in Pakistan, even this Qila and all that. They have some plan anyhow. So you can't simply say that just they have created it, but they have something in mind, and I hope those time also the management accounting has been working. Now let's go for the comparison of these 2 subjects, that is financial accounting and management accounting, because we have this problem that since management accounting is a branch of financial accounting, And this is reality that management accounting is outshoot or outcome of the financial accounting. Now, the differences between these two subjects, managerial accounting and financial accounting. First of all, the origin. So far, financial accounting is concerned, its original is way back 1970 and double entry booking system. But management accounting, we assume that it is a 19th century development. The main purpose of financial accounting is to prepare financial statements. And let me tell you, the financial statements, currently we are producing 4. One is the balance sheet, the other one is the income statement, third one is the change in equity statement, fourth one is the cash flow statement. But there are 3 more statements are going to come, and one of them is started in Pakistan, which is the value added statement. In fact, this value added statement is the new statement which is going to be prepared in Pakistan, and many companies are producing nowadays. Then we have another one called the foreign exchange statements. The company, how much foreign exchange they have been earning, how much foreign exchange they have been spending. So a statement is required. Similarly, there is another one, employment statements, that you should give all the information regarding your human resources, how they have been hired, how they are going to be promoted, what the company is doing for their growth also. Then there is another one which is called future objective statements. So these 4 statements, the additional one, are going to be later on anyhow in Pakistan to become up. Now, so far the statements concerned in management accounting is concerned, the main purpose of management accounting is to provide detailed information, and that information can be in any form because it all depends on the management, what they require. For example, if the management required, for example, in case a management want to see that how much electricity units we have used and what is the production out of that usage of electricity, what is the per unit cost of electricity, per unit cost of electricity cost per unit, so we can simply work it out. So this is entirely a different statement. It's not only the financial statement. It's obvious required by the management that they need to know that if I'm using 1 unit of electricity, so what is my output? So they want to consider the yield regarding the uses of assets. Then third one is the target group. Target group basically mean here that we prepare these accounts, financial accounts, basically for external purposes, outside agencies. In fact, there are a number of outside agencies, those are interested in the accounts of a company. And if I name them, first of all, the shareholders, the government agencies, and many others like state banks also need, bankers also need, even your employees also need. So there are many people who are interested in the financial accounts of the company. But so far, management accounting information is concerned, the target group is only the management. Now, let me explain you about the management, because there is an administration and there is a management and there is an organization. So basically, managers are those who are taking care, those who are carrying out the policies framed by the administration, and they have the resources of organization to implement those policies. Now, if you look into the other part of its statutory requirements, in financial accounting, these have been prepared according to the legal requirements of the Companies Act and many other requirements like Security Exchange Commission of Pakistan, similarly State Banks of Pakistan, prudential regulation and so on. And similarly, you have different types of private limited companies, public limited companies. So for all mudarbas, banks, they got a lot of ordinance we have to follow to prepare these statements in financial accounting. But so far management accounting is concerned, maintenance of these accounts are voluntarily. It's not a must. It is only the management who wants them, and it's the way they want it and in the form they want it. It is basically the management. They are not even shown to other parties. They are confidential. So far financial reports are concerned, they are not confidential. They are published. They are published in almost every year. Every company is going to publish, but so far management accounting information is concerned, whatever statement we produce, they are meant only for internal purposes. Analysis of cost and profit and loss account. Financial account reveal the profit and loss account of the business as a whole during a particular period. It does not show the figures of cost and profit for individual products, departments, or processes. But so far management accounting is concerned, we show the detailed cost and profit and loss account of each product line, even in department and each process. Next is periodicity of the reporting. Now, so far financial accounts are concerned, usually we have to produce at least once in a year, but currently quarterly reports have been prepared. Some companies also prepare monthly reports. So their timing is either monthly, quarterly, or yearly. But so far management accounts are concerned, the process is ongoing on. Even daily reports. For example, in textile industry, if you have been in, let's say, spinning industry, so they have to produce daily basis how much output they have and what is the yield they have worked out. So there is no such time limit that you can produce only on a monthly basis or weekly basis. It is on daily basis, monthly basis, as required by the management. Then the control aspects. Financial accounting lays emphasis on the recording of financial transactions and does not attach any importance of control aspect, because it's a historical things that the things happened and you record it. But so far management accounting is concerned, it provides a detailed systems of control within the help of certain special techniques like standard costing and budgetary control. Then the nature of financial accounting, it is concerned almost exclusively with historical records. The historical nature of financial accounting can be easily be understood in the context of the purpose of which it was designed. Management accounting is concerned not only with the historical cost but also with predetermined cost. This is because management accounting does not end with what has happened in the past. Similarly, another very important thing, that in financial accounting there is an audit at the end of the year, but in so far management accounting is concerned, there is no such audit requirements. We have the cost audit later on. Concept is getting important in some countries, but again in certain countries it's mandatory, but many countries it's not mandatory. The last one is the international accounting standards. Now, in case of financial accounting, there's a lot of development and there's a lot of international accounting standards which have been produced by the learned professors and even the institutions, etc. But so far management accounting is concerned, we don't have as such standards over there, but currently there are management accounting committee internationally working on it and trying to produce something which is internationally to be recognized. Now, things will take time, but inshallah, I hope in some management accounting techniques, management accounting processes, management accounting methods are going to be evolved to be discussed in more and more detail when we come to the subject later on. Now, there is one thing which is very, very important, the management accountant role. Traditionally, the accountant's role was simply to produce financial accounts. But it's not enough anymore, because financial accounting, or rather producing accounts for public or for shareholders' purposes, is taken over by the computer. The traditional role of management accountants have changed now. The management accounting is primarily concerned with the application of accounting techniques and to provision of information designed to assist all levels of management in planning, reporting, and controlling the activities of the organization. Now, the dynamic role have changed. The dynamic role is, in today's business environment, role of a management accounting is much more of dynamic than the traditional role. This is to create and enhance value of the organization through stakeholders. This concept of value creation gives management accountant a more dominant position in the organization. In fact, currently, the most successful accountants are the management accountants and not the chartered accountants, because the management accountants really working hard to add values to the business. And let me give you slightly detailed way how the dynamic roles includes, what dynamic role is include. Number one, value addition. They are supposed to suggest ways and means how to add values to the organization. Then change facilitator, because things have been changing rapidly. So the management accountant should help us that how to change our processes, how to change the alternate resources, because the same thing you kind of produce by using a different resources, different materials. So find out which one is the right material and what is the right process. If you need to change the process, they should help you out how to change the process too. Business advisor, not just a corporate policeman. A policeman not only just to deter people, but to motivate people so that they can see how the business can improve. Being proactive, rather than, there was a time when we used to say feed back, but now we are talking about feed forward, that we should give them in advance, look, this is the way how you can approach your problems. Able to address perceived concerns. If some people are thinking something else, you better sit down and talk to them and find out, look, how to sort it out, these problems. Then business objectives. Here I can explain to you that generally we have in mind the business objective is just simply one, that the addition to the wealth of the shareholders or maximization of the wealth of the shareholders. But that is not enough anymore. Shareholder is simply one party. Now you should take care of all the stakeholders, including the shareholders, including your employees, including your customers, even including the general public. So it's not simply that you can work at your own, and objective should be very, very clear that what we are going to achieve at the end of the day. If you look into the characteristics of a good objective, it should be verifiable, it should be quantifiable, it should be flexible also, and it should be achievable also. So don't fix an objective which is difficult to achieve, because you have to look into your resources, and accordingly you can fit a target to your organization. Similarly, project management, a management accountant will play a very important role, because before you own a project, you have to do a lot of homework before you start any of the project. Feasibility report should be prepared. All the input resources, finance resources, total detail of a project should be taken into account. Similarly, cash flow preparation. That is also very, very important, because inflow and outflow. And in fact, currently, the business have the problem of cash flow. So before you go into more detail, that start any project and then you have a cash flow problem, you must keep in mind that before you start any project, make sure that you have planned properly your cash flow statement. Now, growth initiator. We must see how we can grow, because growth is also very, very important in any business, because you can't just stand alone or you can't simply status quo. No, you have to see how we can grow in the business. Like, for example, if you have 1, 2, 3, 4 products going on in the market, one of them is not being sold, the other one is going very well. The one which is not being sold, try to think about how we can change that product, how we can take out that project and add a new product into it. Similarly, we should do some SWOT analysis. We must look our strength, we must look our weaknesses, we look at the opportunities, and we also see the threats around us so that we can take a right decision. Cost auditor, do remember, all activities you do in a business are costing you. Nothing is free in this universe. So we must take care of our cost. So in case a cost you are incurring, make sure it should add value. And if the cost is not adding value, then it means it's a waste. You must take out that activity which is not adding value. Now, coming to the systems of management accounting. Now, installation of management accounting system, various factors to be kept in mind. But before I go to that, a managerial accounting system is a discretion on the management. It's not a must for every businesses. But currently, globally, if you look at it, all the organization almost having some management accounting system. Now, a system can be very, very difficult, and its system can be very simplified. But the management accounting system, we should consider the following factors before we own any managerial accounting system. The number one point is primary investigation should be made relating to the technical aspects of the business. For instance, the nature of product, the method of production will determine the type of management accounting system to be applied. If you have a very detailed management accounting system, but please keep in mind the cost-benefit analysis, because there is no point that a system have such a huge cost and the benefit is not meeting. So better it is that you must always do a cost-benefit analysis. Number two, the organization structure of the business should be studied to ascertain the scope of authority of each executive, because it is also very much important that you must fix the responsibility of individuals. The existing organization should be disturbed as little as it is advisable for full consideration, because we can't just implement a system or design a system without looking into what is the basic organization structure. Third one, the method of purchase, storage and issue of material should be examined and modified as the requirements. And currently, there are a lot of computer packages available, lot of software development that you have, that resource planning and so on. So we must make use of them, provided if they are cost effective. The existence of method of remunerating labor should be examined for the purpose of introducing an incentive plans. In my opinion, you must give due weight to your employees, because if the employees are not happy, if they are not satisfied, you must take care of them inside the organization. Even you must take care of them outside the organization. Only then the employees can contribute to the success of the organization. Forms and accounting record should design so as to involve minimum clerical labor and expenditure. Unnecessary paperwork is also a waste. There is no need of it. If one paper can do, there is no need of producing two papers. Then the size and layout of the factory should also be studied. You must see how the size and the factory is located. The system should be effective on cost control and cost reduction. In fact, cost reduction word means that start reducing some resource cost, cutting down. No. Here it basically concept is cost saving. We should try to save the cost. Management system should be simple and easy to operate. It's not complicated one. It should be simple and easy to operate. Unnecessary detail should be avoided. Installation and operation of system should be economical. The system should be introduced gradually, not immediately. People take time to understand the new system and they take time to be used to that system. So give them education, give them some training, explain to them how the system is going to be employed. Then effective internal control system is also very important. A lot of emphasis has been given currently on the internal control systems, because if you can control internally, only then you can go ahead and externally also. Now, next is, what are the characteristics of an ideal management accounting system? I mean, which system can we say that is the ideal system? Number one, suitability to the business. It should be simplicity. It should be flexible. It should be economical. It should be comparable. It should be capacity of presenting information at the desired time, minimum changes in the existing setup, uniform of forms, then minimum clerical work, efficiency system, adequate wage procedure, departmentalization of expenses, reconciliation of management and financial accounts, duties and responsibility of cost and management accounts. So these are the basic characteristics of any managerial accounting system. Now, difficulties in a management accounting system. What difficulties we come across when we want to introduce any management accounting system? The number one is lack of support from top management. Let me tell you, I can give you an example. I did an implementation of a ABC costing system in one of the Pakistani company, and just because the top man wants it, the individual in charge, the individual cost department is not willing to do that because it requires a lot of hard work. So they were not inclined to do that system, but the top man wants that you should train them and ask them to implement the system. And we believe it, while introduction of ABC costing system, the prices, the cost, we worked it out that the main product cost was not more, but the cost was the byproducts, or rather joint product cost was more. So we have changed it. So Only the top men who can make the system work. Resistance from existing accounting staff, it's always that whenever a new system is going to be implemented, the staff resent because they were used to doing something previously in an easy way, and now the new system, they have to learn new ways to do things. That's why they resist. Then non-cooperation of other levels of organization. Whenever there is a new system, make sure that all level of management, all the departments, all the sections, they should come together. They should understand that we are in total, we should look into it rather than individually. Then shortage of trained staff. Shortage of trained staff, it's also very, very drastic step here that we are not having a trained staff. Basically, we have been importing, we have been using a lot of new methodologies, new techniques, new systems, and we don't have the trained staff. Because I remember in one of the textile mill, they bought a very, very, very good machine called Blendomet, who mixes the cotton in a different computerized system. But once it is gone bad due to some reason, we have no way, but we have to call a person from abroad to fix it right. So we must, before we get into a new system, before we go into a new, we must keep in mind that we should have a trained people, or rather we should get the people trained so that they can operate effectively. Now, heavy cost of operating a system, I said earlier that the system should not be very costly. It should be cost effective. If you are implementing a system and the cost of implementing a system is greater than the benefit you are expecting, then there's no point of having such a system in operation. Now, this is very, very important that, as I said, in the so far system is concerned, it's the top level, senior management level, should be serious enough if they want the success of any system to be worked out. Now, let's find out the different types of cost which we come across in any business. And we classify these costs into various heads, and one of them is classification according to the functions. 5 functions are very, very distinguished in any organization. The one is manufacturing cost, the other one is administrative cost, the another one is selling and distribution cost, and the next one is the financial cost. The other one is research and development cost. All these 5 distinctive types of cost we have to complete. We have to make sure that each and every cost should be calculated effectively. Then the other classification is variability, fixed cost and variable cost. If you look into the total cost, whether it is functional cost or research and development cost or administrative cost, we need to put into 2 classifications. The behavioral classification, that which one is variable and which one is fixed. Because variable cost is usually under the control of individual who are incurring those costs. But so far fixed cost is concerned, it is broad-based, it is by the management who decide about the fixed. Now, if there is any semi-variable or semi-fixed cost, any mixed cost, so we need to split the 2 because we need to know the total cost into 2 parts, variable and fixed. The third one is classification according to identification with the cost unit. Now, direct cost and indirect cost. Direct costs are which are essential, which are very, very important for the production of any activity, and indirect cost which are allied cost which helps the production process continuing. Next is the classification according to the controllability. Controllable cost, uncontrollable cost. Next is classification on the basis of time, historical cost and predetermined cost. Then by departments, direct departmental cost and indirect departmental cost. 7th is budgeted cost and standard cost. Next is analytical cost. In fact, in management accounting, we give lot of focuses on this analytical process cost. In this, we have the differential or incremental cost, imputed cost, opportunity cost, replacement cost, sunk cost, out-of-pocket cost, future cost, standard cost, discretionary cost, committed cost. All these words which I have just said, they are very, very essential in management accounting. because when we have to take a decision, we must keep in mind the analytical classification of cost, because sometimes it is added to the cost and sometimes we should leave it out of the product cost. So we must go in detail about this costing. Now, one by one, manufacturing cost includes basically three elements. One is material cost, and in material cost we should keep in mind that direct material cost is separate than the indirect material cost. Direct material cost is basically which is the most important cost in any operation, in any productive action. For example, if you want in a shirt, let's say, so the cloth, the fabrics which you use, that is the direct cost. But for the sake of, let's say, a shirt, you need a button, you need sewing threads and so on. So they are also material, but they are not that important. But the main thing is the cloth which is used in a shirt. So that is the direct material cost. Now, indirect material cost, maybe there are many small items we have been using in the production of a product, but they are not as significant as the direct material cost. So that's why we need to put separately the direct cost. Similarly, labor which are directly engaged in the process of production is a direct labor, and if there is some helpers down there, sweepers down there, janitors, so they are all indirect labor and they are not part of direct labor cost, although they are also important, but still we keep them separately, and then we put them into other cost that is called overhead cost. Now, in overhead cost, leaving material, direct labor, all other costs in the process of production, we call them indirect cost, or rather factory overhead cost, or manufacturing cost, manufacturing overheads. Now, another important thing here is that sometimes we have direct expenses also. So I'm talking direct material, direct labor, and direct expenses. Now, these three are becoming the prime cost of any business. Now, what is direct expense? Basically, sometime we need to hire a certain plant which is very essential for the process of production. Then that expense also, it is outside, for still we add it to the direct expenses and add it to the prime cost. For example, if you want to construct a house, you might need shuttering, you might also need some mixtures and so on, but they're not part of your house, but they are just, you rent them out and you pay for their services. So that is also a direct expense. So direct expenses are separated, and then we have the overhead cost. So if we add direct expenses, means direct material, direct labor, and direct expenses, that is our prime cost. And if we add direct labor and overheads, it is called conversion cost. So in fact, conversion cost includes a lot of resources we have been used. Direct labor is okay, that is the employees we are hiring or we are having in our organization, but so overheads are concerned. They are numbers. In fact, if you put down the list, including the very important indirect cost is the energy cost, because currently we have energy crisis also in Pakistan, all over the world. So energy cost is, that is the utilities cost we are talking about. They are the very essential cost also. Then we have the administrative cost. In administration, general administration, we have offices, account offices, we got procurement offices and so on. There are number of offices working with we need to separate them and put it into a heading called administrative cost. Then we have selling and distribution cost. In fact, currently, selling and distribution cost is taking a large part of our budget. In fact, particularly in cosmetics, in technology, computers, lot of administrative, selling and distribution cost. In fact, more than the direct cost. And there are industries where the direct cost is reducing, but the selling distribution cost is increasing. Now, the next is the finance cost. The finance cost is not simply the interest you pay to the banker, but there is a lot of allied cost which bank charge you, like bank charges, service charges, monitoring fee, and so on. So it's all together. If you look at it, the finance cost is a huge amount we are paying every time and now. Now, if you look into the shareholders, they are also expecting the dividends also. So that is also part of finance cost. So what do? We put together the weighted average cost of our total capital we utilize, and then we compare it, the return on capital employed. And if the return on capital employed is lower than the cost of capital employed, I think that's not a right decision. So what we do in management accounting, we are trying to see the balance that our finance cost should not be greater in any case from the cost of our returns. Return on capital employed. So return on capital employed should exceed the cost of capital employed. That's why we have to give due attention to our finance cost as well. The next is research and development cost. Now, research are two types. One is basic research, the other one is applied research. Then the development of that research into a main product line. So all these costs are long-term costs basically, because the research we are taking today may take some time to be materialized. But this cost we have to incur, because if you want to survive, if you want to remain in the business, you need to find out ways and means how to grow, how to put new techniques, new things into market. Because your customers, there was a time when we used to say the customer should be satisfied. Then the question is customer to be pleased. And then it comes to the customer to be delighted. But when it comes to surprise the customer, there they are looking for some innovative product, something new which should help them out, which is required by them. Sometimes, it happens that they get fed up with the same product and they're looking for the same. They need something new. So you have to do such research and then find out new ways of doing things, new products to bring in. Now, I'm not talking about the research going on in, let's say, medicines and all that. I'm talking about the research in any business. So we must keep on doing some research, new methods, new materials, new technologies. We must come to know, but it's a cost. Do remember, it is a cost, and it should be a separate block of cost altogether. And management should work out how much budget they can allocate about the research and development, because it is also very, very essential. The second type of cost classification is the cost variability or behavioral classification of cost. In behavioral classification, we have two types, that is the fixed cost and the variable. Fixed cost is almost fixed irrespective of your production volume. Once it is incurred, it remains fixed. It is not going to change. But so far variable cost is concerned, it changes with the level of production. If the production increases, this cost will also increase. But if the production decreases, this cost will decrease. Generally, we say that the variable cost has a direct relation with the production, while the fixed cost does not have any direct relation with the production cost. Because total cost, if the production increase, will increase, but so far the variable cost increase with the production, but fixed cost will not increase with the production, it will remain fixed. But if you come to work out the cost per unit, so if production increases, the fixed cost per unit will decrease, while the variable cost increases with the increase in production. Per unit cost will remain the same, variable cost per unit remains the same. If it is fixed, it will not be changed. Variable cost will not change per unit, but in total it will change. But fixed cost will remain same in total, but per unit it will change with the increase or decrease in production. Now, in case there is a mixed cost, we need some way out to split the two, variable part and the fixed part, because we can't use the mixed cost in later on when we go to the managerial techniques. We need variable cost separate and the fixed cost separate, because fixed cost, usually we call them, it's not controllable within the range of the operational people, but the variable cost is controllable within the operational people. So we need to split these two so that we exercise the control on the variable cost. And the fixed cost, since it is generally decision of the management, top level management, so we can't do much about it, but we can ask the individual managers about accountability of the variable cost only and not the fixed cost. So in this case, we need to split these total cost of any organization into two parts, the variable and fixed. So fixed is not controllable as such, but the variable cost is controllable. So we try to find out how much total fixed cost we are ready to commit and what is going to be our variable cost, and how we can make, how we should try to, in fact we are going to try to reduce the variable cost as much as possible, because the fixed cost is not going to be reduced in a certain period of time, because it is fixed for a certain period of time. Similarly, fixed costs remain fixed within a range of output. If the output go beyond that range, even the fixed cost is going to be varied also. It also be changing. So it's better to keep in mind that the fixed cost and variable cost are very, very essential for any decision-making process. And inshallah, we will continue next time with the rest of the classification of cost. So that the cost, almost total cost is the same, but only thing is that how we can put it into different forms, how we can split it into two various elements. Thank you very much.